Right now, millions of American parents are making one of the most financially dangerous decisions of their lives, and they have absolutely no idea. They think they are being smart. They think they are protecting their family. They think they are being responsible. But what they are actually doing is handing the government, the banks, and even their own children the keys to everything they have built over a lifetime. We are talking about savings accounts, retirement funds, the house, all of it, at risk. Because of one simple, well-intentioned move that financial advisors almost never warn you about. Adding your child's name to your bank account. And before you say, that's not a big deal, I need you to stay with me, because by the end of this video, you are going to see exactly how that one decision can trigger a tax nightmare, destroy your Medicaid eligibility, hand your child a debt they never signed up for, and in some cases, cost families hundreds of thousands of dollars. This is not an exaggeration. The numbers are real, and the consequences are happening to real people right now. If you are new here, this is Wealth Vision, where we break down the financial traps that most people walk straight into without ever seeing them coming. Hit that subscribe button right now, because what we cover on this channel could genuinely save your financial life. And like this video, if you want more content that protects your money instead of just making you feel good about it. Now, let us get into it, because here is where things get dangerous. Most people add a child to their bank account for one of a few very simple reasons. Maybe they are getting older, and they want someone they trust to be able to access funds in an emergency. Maybe they want to make it easier to transfer money. Maybe they just want their adult child to be able to pay bills on their behalf if something happens. It sounds practical. It sounds caring. And on the surface, it looks completely harmless. But here is what nobody is talking about. The moment you add another person's name to your bank account, you have not just given them access, you have given them ownership, legal, binding, full co-ownership of every single dollar in that account. And that changes everything. Let us start with the tax problem, because this one catches people completely off guard. Say you have $80,000 sitting in a savings account. You add your adult daughter's name because she helps manage your finances. Now, when you pass away, in the eyes of the law, that money may not go through your estate at all. It passes directly to her as a co-owner. That sounds like a good thing, right? It bypasses probate. It goes straight to her, clean and simple. But here is the part that stings. Depending on the size of your estate and your state's laws, that transfer can trigger a gift tax or an inheritance tax that your family was not prepared for. And even worse, your daughter just inherited $80,000 with your original cost basis. If that money grew over time, she could be looking at a significant capital gains tax bill on money she never really spent. The IRS does not care about your intentions. They care about the numbers. And the numbers get even worse when you factor in Medicaid. This is the one that genuinely destroys families, and it happens more than most people realize. If you ever need long-term care, whether that is a nursing home, assisted living, or in-home care, Medicaid becomes critical for millions of Americans. The average nursing home in the United States now costs between $8,000 and $10,000 per month. That is $96,000 to $120,000 per year. Most people cannot pay that out of pocket for more than a year or two before their savings are completely gone. So they plan to use Medicaid, and that is a perfectly reasonable plan. But Medicaid has a 5-year look-back period. That means when you apply, the government goes back through 5 full years of your financial history, looking for asset transfers. And if they find that you added your child to your bank account, and money moved, or was accessible, they can count that as a disqualifying transfer. You could be denied Medicaid benefits, or forced to wait months before coverage kicks in, even if you are in a nursing home, even if you are out of money, because of a decision you made years earlier trying to be responsible. One bad piece of advice, or no advice at all, and suddenly a family is staring at a $90,000 annual nursing home bill with no coverage and no savings left. That alone would be bad enough. But it gets worse. Here is something most people never consider at all. When you make your child a joint owner of your bank account, you are also exposing your money to their financial problems. This is not hypothetical. This is happening to parents all across America right now. Let us say your son has a credit card debt that goes into collections, or he gets sued, or he owes back taxes to the IRS. Because his name is on your bank account, your money is potentially reachable by his creditors. Depending on the state and the situation, a creditor could file a judgment and have funds seized directly from that account. Your savings, your retirement cushion, your emergency fund, gone because someone sued your kid. Or consider this. What if your child goes through a divorce? In many states, assets that are jointly held can become part of a divorce settlement. The money you worked your entire life to save could become a bargaining chip in a legal proceeding that has nothing to do with you. Most people have no idea this is even possible. They added their child's name thinking it was a simple protective move. And then life happened. Now, here is a real-world scenario I want you to think through, because this is where the emotional weight of this really lands. Picture a 72-year-old retired teacher named Linda. She spent 35 years in the classroom. She is careful with money. She saved $210,000 over her lifetime, kept in a joint savings account she set up with her son Michael about 8 years ago, because she wanted him to be able to handle things if she ever got sick. 3 years ago, Michael went through a nasty divorce. His ex-wife's attorney discovered the joint account during the asset discovery process. Linda spent over $14,000 in legal fees just defending her own money. She did not lose it in the end, but she came terrifyingly close, and she burned through savings and experienced stress and anxiety that no 72-year-old should ever have to face. And then, last year, Linda needed hip surgery, followed by rehabilitation care. She applied for Medicaid to help cover the extended care costs. The caseworker flagged the joint account. Because of the account structure and some transfers that had moved through it over the years, Linda faced a partial look-back penalty. She had to pay several months of care out of pocket before Medicaid coverage began. At $280 a day, that added up fast. Linda did not make bad decisions because she was reckless. She made them because no one told her the rules. And that is exactly why this video exists. So what should you do instead? Because this is the part that most channels skip, and it is the part that actually matters. The first and most important alternative is a durable power of attorney. This is a legal document that gives your chosen person, whether that is a child, a spouse, or a trusted friend, the authority to manage your finances on your behalf if you become incapacitated. The critical difference is that power of attorney does not transfer ownership. Your money stays yours. Your child has the authority to act, but they are not a co-owner. That distinction protects you from their creditors, their divorces, their tax problems, and it keeps your Medicaid eligibility clean. The second option is a revocable living trust. This is one of the most powerful estate planning tools available, and it is surprisingly underused. With a revocable trust, you transfer your assets into a trust structure during your lifetime. You remain the trustee, which means you control everything. You name a successor trustee, often your child or children, who steps in and manages the trust if something happens to you. Assets in a trust pass directly to your beneficiaries without going through probate, which saves time and attorney fees. And because the trust is a separate legal entity, it provides much cleaner protection from the creditor and Medicaid issues we just discussed. Setting up a basic revocable living trust typically costs between $1,500 and $3,500 depending on your state and attorney. That sounds like a lot until you realize that one Medicaid denial could cost you $8,000 to $10,000 per month. The math is not even close. The third option is a payable on death designation, sometimes called a POD or a TOD, which stands for transfer on death. You can add these designations directly to your bank accounts and investment accounts right now without any legal help. They are free, they take maybe 15 minutes at your bank, and they allow you to name a beneficiary who receives the funds when you pass away, without ever being a co-owner while you are alive. Your money stays completely yours. Their name is not on anything. Their creditors cannot reach it. Their divorce attorney cannot see it. And when the time comes, the transfer is clean and fast. This one simple step, switching from joint ownership to a payable on death designation, eliminates almost every risk we have talked about in this video, and it costs you nothing. Now let us zoom out for a moment, because there is a bigger financial picture here that connects all of this. We are living through one of the most complicated economic periods in modern American history. Inflation has hit everyday Americans hard. The cost of long-term care has risen dramatically. The average American 65 and older can now expect to spend over $300,000 on healthcare costs in retirement, and that number climbs every single year. Social Security faces long-term funding questions that nobody in Washington seems eager to solve. And bank failures in recent years have reminded people that nothing is completely bulletproof. In this kind of environment, the decisions you make about how your money is structured, not just where it is invested, but how it is legally titled and who has access, those decisions matter more than they ever have before. One wrong title on one account can undo years of careful saving. One overlooked legal document can trigger a chain of consequences that takes your family years and tens of thousands of dollars to untangle. And here is what nobody is talking about when it comes to this specific issue. Estate and elder law attorneys say that joint account problems are among the most common financial disasters they clean up. Not investment losses, not bad real estate deals. Joint accounts set up by loving, well-meaning parents who just wanted to make things easier. The road to financial disaster, it turns out, is often paved with the best intentions. If you have already added your child to your account, do not panic. This is fixable. The first step is to sit down with an estate planning attorney, not a general financial advisor, but someone who specializes specifically in elder law and estate planning. Tell them exactly how your accounts are titled, what your goals are, and what your health and long-term care situation looks like. They can help you restructure things in a way that achieves everything you actually want, protecting your child, simplifying your estate, and ensuring seamless access in an emergency without any of the legal and financial landmines we covered today. The second step is to review every account, every brokerage, every retirement account, and every piece of real estate you own. Look at how it is titled. Look at who is named as a beneficiary. These details are not set it and forget it. Life changes, laws change, your financial picture changes. An annual review of your account structures is one of the highest value things you can do for your family's long-term financial security. And the third step is to have the honest conversation with your kids. Not just, here is how to access the money, the real conversation. Here is my estate plan. Here is where the documents are. Here is who my attorney is. Here is what I want to happen and why. That conversation, as uncomfortable as it might feel, can save your family from months of confusion, conflict, and legal cost when the time comes. Because here is the truth that ties all of this together. The biggest financial mistakes people make are rarely dramatic. They are not reckless gambles or obvious scams. They are quiet, well-intentioned decisions made without full information. A name added to an account. A beneficiary form never updated after a divorce. A power of attorney never created because nobody wanted to think about getting old. Small decisions with enormous consequences. You work your whole life to build something. You deserve to have it protected properly, not just in terms of investment performance, but in terms of legal structure, tax efficiency, and estate planning. All of it working together. All of it serving the people you love. So here is where I want to leave you today. If you have a joint account with a family member, go look at it this week. Just look at how it is titled. Ask yourself if a payable on death designation would serve the same purpose with far less risk. If you do not have a durable power of attorney, put it on your calendar this month. If you have been putting off creating a trust or updating your estate plan, let this video be the nudge you needed. The financial system is complicated, and it does not always reward the people who try hardest, but it does reward the people who are informed. And now, you are one of them. I want to hear from you in the comments. Have you added a family member to your bank account? Did you know about the Medicaid look-back rule before watching this? Are you someone who has already dealt with a situation like Linda's? Drop your story below, because your experience might be exactly what someone else needs to hear today. If this video helped you, please share it with a parent, a sibling, or anyone you know who is thinking about making this kind of financial move without fully understanding what it means. Like the video so more people can find it. And subscribe to Wealth Vision so you never miss the financial truth that the system hopes you never learn. Stay smart, stay protected, and we will see you in the next one.